This is Janus Dispatch. Architecture over narrative. Today's topic: completing Flare Network's FIP16 with a wealth fund model. From fee burn to sovereign capital. On June 2, 2026, three things happened in 8 hours. Morpho announced a $175 million raise from Paradigm, a 16Z, crypto, and Ribbit Capital, calling itself the Open Credit Network for a $200 trillion global market. Firelight published its Risk Consortium with 5 named partners and an on-chain payout waterfall. And in the Flare Foundation stream that followed, Hugo Philion said the line out loud, quote, "There's organic yield. There's some inorganic yield as well. Now it's really time to consolidate and grow that," end quote. 3 signals. 1 question. The institutional capital is real. The credit and cover architecture is being built around it. And the foundation has acknowledged that the current Flare yield mix is not yet what it needs to be. The question is what the foundation does with the captured value it already controls, not what it asks others to do. This piece proposes one answer. It is not the only one, and it is not in tension with the demand stack prescription in from renting to owning. It is the treasury side complement to the ecosystem side recruit. The macroeconomic dilemma of Layer 1 bootstrapping. Layer 1 networks face a binary choice for handling captured value. They burn it, removing tokens from supply and starving the ecosystem of vital growth capital. Or they distribute it as inflationary incentives, paying for activity that may or may not become organic. Both have known costs. Burns tighten supply without funding new infrastructure. Subsidies inflate supply to attract liquidity that may leave once subsidies dry. FIP16 sits in the middle of this binary by routing fees and MEV through FIRE into FLR buybacks. The math improves the supply curve. It does not by itself decide what the captured value should fund beyond reducing inflation. That decision is upstream of any specific protocol. A sovereign network needs to transcend the binary. The frame this piece uses for that move is the Sovereign Wealth Fund, the SWF, not the central bank. The distinction matters, and it matters in a specific way that the rest of this piece will return to. Why Sovereign Wealth Fund, not central bank? A central bank has 2 powers a Layer 1 foundation does not have. It can print money against itself as a lender of last resort, and it can set monetary policy with state-backed legal authority. When something breaks, a central bank backstops with newly issued reserves. The Flare Foundation has no equivalent. It cannot print FLR into a smart contract exploit hole. It cannot raise short-term rates to defend a peg. The central bank analogy reads well, but is mechanically wrong. A sovereign wealth fund is the correct comparison. Norway's government pension fund, Global, Singapore's GIC, and the UAE's ADIA hold captured wealth from past surplus, oil revenue, fiscal surplus, trade surplus, and deploy it across asset classes over long horizons. They are subject to fiscal discipline. They do not print money. Their returns benefit a defined set of beneficiaries: citizens, future generations, fund holders. They are rule-based, transparent, and structurally cautious because they cannot bail themselves out. The Flare Foundation maps onto the SWF model cleanly. Captured FLR from FIRE, from inflation reduction, from MEV routing, is the fiscal surplus. The beneficiaries are the FLR holders. The deployment mandate is the chain's economic infrastructure. The discipline is the absence of any backstop. If a deployment fails, the loss is real and irrecoverable. That asymmetry shapes everything that follows. The return capital spectrum. Before the SWF prescription becomes concrete, it helps to locate it against the other answers to the same question. Where does captured value go? 3 live design points frame the spectrum. At one end sits the hard buyback model. Hyperliquid's assistance fund, approved by validators in December 2025, routes 97 to 99% of protocol fees into open market hype purchases. Cumulative buybacks crossed $1.16 billion by mid-2026, Q1 2026 alone accounting for $192 million. Buyback intensity runs at roughly 7% of market cap annualized, 4 to 5 times ETH or BNB. The design maximizes return of value directly to the token via price support. For a trading venue that has already found product market fit with $1.3 billion in annualized fee revenue, this is coherent. The reinvestment need is smaller because the product is already running. In the middle sits the soft buyback via burn model, FIP16, approved April 24, 2026. Establish FIRE as the foundation's fee and MEV routing mechanism into FLR supply reduction. It is economically related to hard buyback but structurally distinct. Where the assistance fund holds bought-back tokens, FIRE removes them from circulation entirely. Both models return value to remaining holders. Both prioritize supply-side arithmetic over ecosystem depth. At the other end sits reinvestment, captured value deployed as anchor liquidity, underwriting capital, or protocol seeding, generating real yield that flows back to the foundation and, under a residual claim design, to the token. This is the SWF model. It is not a criticism of the buyback pole. It is a different optimization for a different phase of the network. The design question is not which model is correct in the abstract. It is which model matches the network's stage. Hyperliquid optimizes for a mature revenue engine. A Layer 1, still bootstrapping its ecosystem, faces a different menu. Where FIRE currently sits on this spectrum is the next thing to look at, because it determines what the room for maneuver actually is. Where FIRE currently sits. First, the capture side. FIP16 has 2 live phases governing what FIRE ingests. Phase 1, activated mid-May 2026, cut annual FLR inflation from 5% to 3%. Phase 2, activated end of June 2026, raised the base gas fee 20-fold and turned FIRE into a scaled burn engine, projected at roughly 300 million FLR annually against the roughly 15 million FLR annualized baseline that preceded Phase 2. The proposal designates 5 explicit revenue sources routed into FIRE's incentive pool: FDC request protocol fees, F-assets protocol fees, Flare Smart Accounts protocol fees, fees from attestations and system-level messages in FCC, and network-wide MEV capture. Where the split is specified, the FDC increases base fees from 1 FLR to 20 FLR. 90% flows to the FIRE incentive pool, and 10% continues through the existing rewards path. The projection is design capacity, not observed throughput. What is actually burned or captured depends on transaction volume on the base layer, and the base layer fee footprint today is small. Chain gas fees run at roughly $37,000 per year. Application fees paid by users run at roughly $657,000 per year. set against the RFLR outflow of roughly $5.62 million annualized at current FLR price and Epoch 23 emissions. The fee basis on which Fire currently operates is a fraction of what the Foundation spends to keep TVL on the chain. The pipes are lit. The volume is not yet arriving at scale. Second, the deployment side. FIP16 also codifies what Fire is allowed to do with what it captures. The proposal defines a primary mandate and 5 ranked allocation priorities. The primary mandate is FLR supply reduction to the maximum extent possible. The secondary mandates are encouraging economic activity on the network and long-term Foundation sustainability across security, engineering, application development, and ecosystem growth. The 5 initial allocation priorities in FIP16 order. 1. Buy FLR on the open market, burn or other mandate use. 2. Validator and staker rewards to push effective inflation below 3%. 3. Asset issuer rewards proportional to activity and MEV on issued assets. 4. Yield and liquidity through decentralized applications to expand economic activity. 5. Foundation sustainability in development, security, and ecosystem growth. Governance is administered by the Flare Foundation initially, with an overtime transition to a committee of internal and external members that will manage the entity. This ordering matters. Fire, by its own name, is a reinvestment entity, but priority number 1 is buyback. Priorities 2 through 5, the ones that would build the ecosystem the burn projections depend on, are structurally secondary. Under scarce capture, which is the current state, a supply reduction first ordering routes almost everything to priority 1, and the ecosystem growth priorities compete for what remains. Third, what the SWF proposal changes. The Sovereign Wealth Fund model does not require expanding Fire's mandate. The 5 priorities already exist in FIP16. What changes is their weighting. Priority 1, supply reduction, is preserved via disciplined burns sized to keep FLR inflation neutral on the net zero baseline the next section defines. Everything captured above that baseline is redirected into priorities 3 and 4, treated not as residual items but as strategic ecosystem infrastructure. Asset issuer rewards become anchor liquidity into the pools those assets need. Yield and liquidity through decentralized applications become protocol-owned liquidity positions in the 4 pillars this piece specifies. Foundation sustainability, priority 5, continues as before. This is why the framing throughout this piece has been FIP16 completed, rather than FIP16 replaced. The design capacity Hugo Philion pointed to in the June 2nd stream, quote, "Fire revenue may not all be used to buy back FLR. We are exploring where and how it could otherwise be deployed," end quote, is not a departure from the proposal. It is activation of the priorities the proposal already ranks as 2 through 5. The Sovereign Wealth Fund model gives that activation a coherent structure and a measurable target. The baseline, net zero inflation. Before generating growth, a network has to protect its native asset from the Cantillon effect. Passive retail holders should not absorb the cost of inflation while a small set of recipients captures the subsidy. FIP16 already moves in this direction by linking burn to usage. The SWF model formalizes the principle. The Foundation should dynamically burn enough captured FLR to offset new emissions before deploying any surplus elsewhere. This produces a net zero inflation baseline. The protected token is the precondition for any deployment that follows. If the baseline is not held, the SWF deployment becomes another subsidy in a different costume. Net zero is not the goal. It is the floor. Capturing the past to provision the future. Once net zero is established, the question becomes what to do with the remaining surplus of captured FLR. Leaving it dormant in foundation wallets is the easiest answer and the worst one. Captured capital that does not deploy is capital that does not compound, and a foundation balance sheet that grows passively is one that is not earning its mandate. The SWF principle is straightforward. Captured value from the past should underwrite the infrastructure of the future. This is achieved through protocol-owned liquidity, POL. Instead of paying users to provide liquidity through emissions, the foundation deploys its own surplus, FLR, to become the primary liquidity provider and the dominant underwriter of the network. The foundation does not subsidize others to do this work. The foundation does this work. That is the structural difference between this prescription and from renting to owning. From renting to owning argues that the RFLR subsidy budget should be redirected to demand-side builders, duration markets, cover venues, hedging primitives, as an ecosystem recruit move. This piece argues that some of the captured value should bypass external recruitment entirely and deploy directly into those venues from the foundation balance sheet. Both moves are needed. They address different parts of the same problem. Architecting the flare economy. 4 pillars of POL. To attract institutional capital and the billions in F-assets that the foundation is courting, the chain needs deep financial plumbing. The foundation deploys POL into the 4 primitives that institutional capital needs before it commits. None of these primitives is novel. All 4 exist in traditional finance and in the more mature corners of crypto. The question is whether they exist on Flare at the scale and depth that allows institutional capital to actually use them. Pillar 1. Spectra and the native yield curve. The move. The foundation seeds baseline liquidity into the Spectra fixed-rate pools that anchor the term structure curve. Not into one pool, but across the maturity spectrum in volumes that the market can rely on. The impact: a functioning credit economy needs a predictable price of money over time. Today, the Spectra Flare curve concentrates in single subsidized pools and disappears at other maturities. The Spectra Companion essay documented this as the no-curve pattern. Foundation POL, as anchor liquidity provider, creates the conditions for an actual curve to form, because the curve does not depend on whether mercenary capital chooses to seed every maturity. It is anchored by treasury commitment that does not exit when the next pool gets more rewards. This is the institutional precondition. Treasuries that buy duration need to know the duration market exists tomorrow. POL provides that durability. Pillar 2. Kinetic and fixed-term lending. The move. The foundation provides baseline underwriting liquidity to Kinetic's money markets, with explicit support for the fixed-term lending products that institutional borrowers need. The impact: deep credit markets are the bedrock of traditional finance. Morpho's $175 million raise this week makes the scale of demand for on-chain credit infrastructure explicit. Supporting Kinetic's fixed-term offering removes the systemic risk of highly volatile, decentralized finance utilization curves and gives institutional borrowers and F-asset minters access to stable, predictable borrowing rates. This is the duration gear primitive that the demand stack thesis identified as missing. Morpho's white paper architecture is portable to Flare's EVMC chain. POL gives a kinetic-anchored implementation of that architecture institutional-grade depth from day one. Pillar 3, Firelight and on-chain insurance. The move. The Foundation deploys FLR as underwriting capital into Firelight's decentralized insurance pools, alongside the Risk Consortium structure announced June 2nd. The impact: institutional capital will not bridge billions in F assets without robust cover against smart contract exploits, agent slashing, and de-pegging events. The Risk Consortium provides the claims review framework. POL provides the underwriting depth. The two together turn Firelight from a venue that needs depositors into a venue that has a dominant anchor underwriter and uses external capital for diversification, rather than for survival. The label insurer of last resort belongs to central banks with money printing capacity. The SWF framing here is more accurate and more honest. Foundation POL into Firelight makes the Foundation the dominant underwriter, not the lender of last resort. It collects insurance premiums as real revenue. It also accepts that if the underwriting math goes wrong, it loses the capital. There is no backstop. The discipline is built into the position. Pillar 4. Deep derivatives. The move. The Foundation provides the initial liquidity for native options protocols on Flare, powering automated vaults for covered calls and cash-secured puts. The open RFP for native options on Flare, covered calls and cash-secured puts for FLR and FXRP, FTSO priced, F-asset native, no bridging, sketches the architecture that POL would seed. The impact: sophisticated participants need derivatives to hedge their F-asset positions. Options markets suffer a severe cold start problem because they need substantial initial liquidity to function at all. POL solves the bottleneck directly. The Foundation bootstraps the derivatives plumbing while capturing the volatility risk premium, the VRP, as a revenue stream. The VRP is one of the most studied and most durable sources of yield in traditional financial markets. Capturing a portion of it on-chain, on Flare-native venues with Foundation anchor liquidity is the cleanest path to deep options markets on the chain. This is also where the demand stack thesis from renting to owning and this piece converge most directly. The RFP is the architecture proposal. POL is the funding mechanism. Both exist. They have not been combined. The real yield flywheel. Across the 4 pillars, the Foundation earns 4 distinct streams of real yield: trading fees and impermanent loss-adjusted returns from Spectra, interest income from kinetic underwriting, insurance premiums from Firelight underwriting, option premiums, and VRP from the derivatives venues. None of these requires inflation. All 4 require activity. This is the structural exit from the rented deflation loop, where today the FIRE mechanism captures fees that depend on activity recruited by emissions. POL captures fees from activity it underwrites directly. The yield is real because the underwriting is real. The capital is at risk. There is no subsidy circulation hidden inside the numerator. The Foundation has 2 options with this real yield: systematically buyback and burn FLR on the open market, reinforcing the net zero baseline and tightening supply through genuine demand, or reinvest into deepening the same 4 pillars, compounding the Foundation's position as anchor liquidity provider. Both choices generate organic supply pressure on FLR that does not depend on retail dilution. The capture condition. The flywheel above assumes something the token itself does not guarantee, that yield generated by foundation-deployed liquidity actually reaches the FLR holder. It is worth being precise about why that assumption does not hold automatically. In a company, both branches of capital allocation reach the shareholder. A dividend or buyback returns cash directly. Reinvested revenue builds moat, and the shareholder captures that moat because equity is a legal claim on the entire enterprise. The link is structural. A token usually is not. When the foundation deploys fire-captured FLR as Pillar 1 anchor liquidity on Spectra, the value it creates, deeper curve, tighter spreads, institutional participation, accrues to the network. It reaches the token only if the token is engineered to capture that usage. Fee burn does this indirectly through supply reduction. Direct claims on foundation-earned yield would do it structurally. This is the reinvestment catch. Buyback answers the capture question directly and hollowly. Reinvestment is the growth-appropriate move, but defers the capture question rather than solving it. The sovereign wealth fund frame carries this weight. Norway's government pension fund Global works because the beneficiaries are legally defined. Norwegian citizens with a claim on the fund's returns. For Flair, the beneficiaries would be FLR holders. Only if the token mechanic makes that ownership real, not symbolic. Real can look like several things. Revenue share on foundation POL positions. Governance rights over treasury deployment. Validator yield capture. Structural fee routing back to holders. Whichever mechanism is chosen, the design has to be explicit. Reinvestment without a residual claim layer builds a stronger chain and a weaker token at the same time. The SWF prescription is complete only when both layers are engineered together. Falsification. What could break this model? This thesis is falsifiable, and the falsification path is concrete. 3 markers, all observable on public dashboards. First marker, a POL pool, drawdown exceeding 30% of deployed capital from a single smart contract exploit. The SWF model accepts that there is no lender of last resort. That acceptance is the discipline. But if the actual drawdown event materializes at that magnitude, the foundation treasury contracts materially. The model fails its risk management test, and the case for retreat to pure burns becomes serious. Tracker. Quarterly foundation treasury reports exploit event ledger. Second marker, foundation POL exceeding 40% of chain-wide TVL within 24 months of activation. The model accepts that the foundation will be a dominant liquidity provider. That dominance is the point. But if external capital does not arrive alongside foundation capital, the chain becomes effectively a single treasury venue, and the decentralization claim becomes ornamental. Tracker. Defilama TVL composition. Foundation, treasury on-chain, attestation. Third marker, real yield capture ratio, POL yield, divided by network inflation, below 1.0 over a rolling 12-month window. The model assumes that the 4 pillars generate enough activity-driven yield to outpace residual emissions. If they do not, the SWF model is not self-sustaining, and the foundation is paying for its own infrastructure through ongoing dilution. The flywheel does not turn. Tracker. Monthly real yield capture ratio update. Transparent methodology. If any one of the 3 markers triggers, the SWF prescription is wounded, but not necessarily wrong. If two trigger, the prescription is structurally challenged. If all three trigger inside 30 months, the prescription is wrong, and the burn-only baseline of FIP 16 is the better default. Three tensions the prescription has to hold. The model has three structural tensions, and the honest version of the case has to name them. Tension 1. Centralization gravity, foundation P, OL deployment at scale, means the foundation controls a substantial share of the chain's liquidity. This is the same critique that applies to large SWFs in traditional finance. Dominant treasury actors influence market dynamics in ways that distort price discovery. The classical answer is governance discipline, transparent rule-based deployment, public reports, defined limits per pillar, an explicit pathway to dilute foundation dominance as external capital arrives. Norway's government pension fund Global offers a working template. Singapore's GIC is the more activist alternative. Both work in traditional finance. Both are also ultimately promises, reversible at the next governance vote. On-chain, a sharper answer becomes available. Deploy the SWF not as an entity the foundation operates, but as an autonomous contract it cannot revise. The mandate is written into code. The parameters are fixed. There is no admin key to reach back and change the rules. This is not transparency, it is credible commitment. The classical framing is Ulysses at the mast. Legitimacy bought by giving up discretion. Central banks buy inflation credibility through independence. A foundation could buy treasury credibility through irrevocable self-binding. On standard EVM, an autonomous contract usually retains a multi-sig or an upgrade proxy that a team still controls. Flare Confidential Compute changes this. Protocol-managed wallets inside a trusted execution environment hold the keys inside the enclave, and no party holds them externally. This is the difference between, quote, we could intervene, but promise not to, end quote, and, quote, we structurally cannot intervene, end quote. It is what makes autonomy real rather than merely claimed. Autonomous is only as autonomous as its weakest attachment point. 4 buckles determine whether the mast holds. The falsifiable audit list. Buckle 1, the upgrade or admin key. A proxy, a pause function, an emergency module, any of these means control has moved one layer up, not vanished. Buckle 2, the mandate governance. If an FLR vote can revise the mandate, and FLR governance is itself foundation adjacent, the concentration has migrated from treasury to governance. Buckle 3, the enclave image. Whoever can replace the TEE image controls the contract in practice. Attestation has to nail down an immutable, publicly verifiable image. Buckle 4, the input feeds. The contract needs prices from FTSO, parameters, and a venue whitelist. Autonomous execution over foundation-controlled inputs is control routed through a contract. 2 further objections belong in the balance. The immutability trap. The more credibly autonomous, the less adaptable. A $1 billion immutable contract with a bug and no owner is the DEO in 2016, where the fix was a hard fork, meaning the community reclaimed control anyway. Real sovereign funds are deliberately not autonomous. GPFG has a board. GIC has managers. Markets change and mandates need to update. Full autonomy trades adaptability for credibility. Separately, autonomy kills discretion risk, not size risk. A rule-based whale still moves the market. The autonomous contract answer resolves, quote, will they abuse the control, end quote, not, quote, does a dominant actor distort price discovery regardless of intent, end quote. Concentration remains a function of the dilution pathway. Net, the autonomous contract path, is the strongest available answer to the discretion, half of the tension, and it is genuinely new. Traditional finance does not have this option, but its novelty is its untested risk, and its credibility is only as hard as the four buckles above. The falsifiable question the essay carries forward is whether this would be Ulysses at the mast or a mast with a quick release, a cleaner trade-off with an explicit audit list, not a solved problem. Tension 2. The token holder discrepancy. If the foundation captures real yield directly, FLR holders are not the immediate beneficiaries. The traditional SWF returns flow to defined beneficiaries: Norwegian citizens, Singaporean reserves. The FLAIR equivalent has to make the return to holder path explicit. Buybacks and burns are the cleanest version. Direct distributions to staked FLR are the more ambitious version. Without an explicit path, holders become passive observers of a profitable treasury, which is not the value capture mechanism they signed up for. Tension 3. The mandate paradox. In the June 2nd stream, Hugo described FLAIR's main business as, quote, building and providing great technology for assets to be used, end quote. That is the tech and asset provider mandate. POL deployment into application layer venues is, by Hugo's own definition, outside that mandate. The SWF prescription requires either a mandate expansion, foundation as tech provider and treasury allocator, or an explicit governance carve-out. Foundation treasury operates under separate rules from foundation engineering. The prescription is incoherent without one of those two moves. Where this sits in the larger argument. Rented deflation diagnosed the loop. From renting to owning, prescribed the ecosystem recruit response, redirect the subsidy budget to demand-side builders. This proposal is the Treasury deployment complement. The foundation funds the same primitives the demand stack identifies, but it funds them from its own balance sheet rather than from external subsidy. Both moves can run in parallel. Neither alone solves the problem. What follows is the Scheinriese, the macro capstone that takes both prescriptions and asks what the picture looks like when the chain has had 18 months to either adopt them or not. This proposal is one of the two paths the foundation can walk to make Scheinriese unnecessary as an autopsy. From renting to owning is the other. Walking neither is the third option, and the most expensive one. A proposal for the foundation. This piece is written as a proposal, addressed to the entity that controls the deployment choice. The FLAIR Foundation holds three assets that make an SWF model feasible now, rather than in some distant post-scaling future. A functioning capture mechanism, FIRE, an accumulating treasury of captured FLR, and public statements from leadership that the deployment path is not fixed to buyback alone. The vision this piece proposes is not a shift away from FIP 16. It is FIP 16 completed. Net zero baseline preserved via disciplined burns. Everything captured above that baseline deployed as sovereign liquidity into the four pillars the ecosystem needs to graduate from rented TVL to organic activity. Real yield flowing back as compounding capital. Residual claim design engineered into the token so that the flywheel reaches the holder, not only the network. None of this requires the foundation to redefine its mandate. It requires the foundation to treat captured value as sovereign capital under long-horizon stewardship, in the mode of Norway's Government Pension Fund Global or Singapore's GIC, rather than as fuel exclusively for supply-side arithmetic. The mechanism is built. The Treasury exists. The permission has been publicly signaled. What remains is the design decision. The falsification markers above are the honest test. If the SWF path is wrong, 3 observable failures will show it within 24 months. If it is right, the same window will show organic real yield replacing subsidized deflation as the source of FLR's value. Either way, the answer will be visible on public dashboards. That was Janus Dispatch. Sources, charts, and disclosure are in the published post. If this dispatch sharpened your read, subscribe. Janus Dispatch is at janusthewatcher.substack.com. Janus also runs one-on-one confrontation. 60 minutes, 1 decision, no follow-up, for people who carry responsibility and want their thinking taken apart before it costs them. 1 sentence is enough. Details on the confrontation page at Janus Dispatch. The long arguments are in the books. The transition sequence, 2 volumes, 1 thesis. The ground is shifting. Book 1, The Proto-Post-National Age. Book 2, The Frame. Available on Amazon, paperback, and Kindle. The dispatches connect. The books carry the weight. Architecture over narrative.